In today's video, I want to share with you a case study. Somebody that has $1 million and their question to their financial advisor is, how long can I expect this money to last me in retirement? And whether you have $500,000, $1 million, or whatever your amount is, obviously it's a super important question for all of us because none of us want to have to worry about running out of money once we've pulled the trigger, once we've retired. So let's jump in, let's go over this. So I'm using a free online tool so that you can follow along. It's on honestmath.com and it's super high level. There's only 4 sections. So it's great for a video like this to just high level go over the main things to think about. So the first section is your personal information. So here I'm putting in the $1 million. The person's age 60, they want to retire now, and they're going to start taking Social Security at 62. You can see I've got the Social Security benefit coming in at $2,000 a month. That's just an assumption that I made. And you can see here at age 62, this is from data from the Social Security Administration. At 62, you're going to get 70% of your full retirement age benefit, which would be for this person at 67 years old. And for their portfolio, they have $1 million of liquid assets. And the rest of it is just the defaults that Honest Math puts out. 60% stocks, 40% bonds. Then we go to expenses, and I'm putting in $6,000 a month for the expenses just to see how that turns out. You can see the rest of it is just the defaults for Honest Math. You can change any of these. And unfortunately, when you look at this data, unfortunately, the person runs out of money. And what we're seeing here is the result of a Monte Carlo simulation. The top of the curve are the people that are doing the very best, that ended up getting the best results. A Monte Carlo simulation, in this case, is 10,000 different scenarios that the software ran to help you understand the likelihood of running out of money. So the top of the blue curve represents people that got fortunate. The bottom of the blue curve represents people that were unfortunate. Really, the sequence of return, when they got bad returns, when they got good returns. And that dark blue line you see is half the people do better, half the people do worse. That's the median. So you can see the median person runs out of money at 81, and that's no good. Any financial advisor is going to tell you that. So let's go back to the expenses. And instead of spending $6,000 a month, the only thing I'm changing here is they're going to spend $4,500 a month. Everything else stays the same. And you can see this looks a lot better. The median person ends up at 90 years old, still having $1 million. The fortunate people have about $3 million. And some people do run out of money before they reach 90 at about 86 years old. Okay, so how long will $1 million last? Well, obviously it depends on how much you're spending. Depends on your what inflation is. It depends on how the stock market does. So this is just one scenario. You can run a bunch of different scenarios to get a feel, high level, as to how long $1 million will last. But I want to show the trade-off. What happens if instead of retiring at 60, you keep working? I'm just going to go to an extreme, to 67. You keep working to 67 and you take Social Security at 67. So during this period of time, you don't have to take money out of your account. And I have this person making $75,000 a year. It's going to increase by 2% a year. Social Security is going to be $2,860. That's just the full retirement age benefit. If you take 70% of that, you would get that same $2,000 that I ran to earlier. Again, going out to age 90 under expenses. Now I've got this person, instead of spending $4,500, let's go back to that $6,000 a month. The rest of it is the defaults. And you can see here, this person's in great shape. $1 million is likely, highly likely, going to last them their lifetime. You can see the median case is about $2.5 million. The unlucky people end up reaching 90 years old at about $1 million. And then the fortunate people end up with $6 million. So this is a really solid plan. So let's raise the expenses All I'm doing here is I'm going back to the expense column and instead of spending that $6,000, let's raise it to $7,000 a month. We run the scenario again. You can see this median line, this dark blue line, goes crazy in a good way. You'd like to have that. So they got a lot of really good returns in this scenario. And then they come back down. They had a period of time where they didn't do so well. Importantly, that happens later in their retirements. Okay, so the top of the blue shaded area is 4.5 million. You can see the unlucky people are running out of money right at 90. So those people are running out of money completely, but you can see that wide variance between the people that got unlucky and the people that got lucky, and basically everything else is the same except for the sequence of returns that they're getting. Unfortunately for those unlucky people, they had poor returns early on. So how long will $1 million last? And the answer is it depends. It depends on a lot of things. It depends on how long you're going to live. It depends on how much you're going to spend. It also depends on the type of accounts that you have. And this is a really important point, that $1 million is not always $1 million. If you have $1 million in your company's normal 401k, and that's all of your retirement assets, then what's going to happen under the current tax laws, and I'm not an accountant, I should share that, and none of this is financial advice, I don't know your situation, but when you take money out of a normal 401k, out of a normal IRA, it comes out as ordinary income, so you're going to get taxed on that. And the joke in my industry, admittedly, it's not very funny, is, the challenge with having all of your money in a regular IRA or regular Roth is, every time you fill up your car with gas, every time you go to the grocery store, not only are you paying the sales tax on that, but you're also paying income tax on that because it's going to be taxed as ordinary income. And few of us want that. So if you've got time between now and when you retire, really think about the three main buckets of retirement assets, and that is your regular IRA, your regular 401k, and then your Roth IRA, your Roth 401k, where you don't get the tax break on the way in, but then you don't have to pay taxes on the way out. And then finally, your regular taxable account, where you got no tax break going in. This is like your bank account, a taxable brokerage account, whatever it is. You got no tax break on the way in. And as the account grows, if it's taxable income, if it's interest, you're likely paying tax on that as you go. That's what I call a tax me as I go account. So you want to have your money spread out across those three accounts so you can take advantage of the two lowest tax brackets in the U.S. tax system, the 10% federal tax rate and the 12% federal tax rate. Because after that, there is no 14, 16, 18% tax bracket. After that, it jumps way up to 22%. So you want to have those three buckets, and you also want to be very thoughtful and deliberate about how you spend your last 10 years before retirement. And that's why I made this video up here, which are 8 things to stop doing in your 50s and 60s in order to enjoy your journey more. Thanks for watching this video. I'll see you in the next one. Bye-bye.